Alphabet Incorporated, Nasdaq, Google, the parent company of Google, has demonstrated robust financial performance and strategic initiatives that position it well in the competitive tech industry. As of May 17, 2025, Alphabet's stock is trading at $166.19, reflecting investor confidence in its strategic direction and market positioning. Financial performance: strong growth amidst global challenges. Q1 2025 financial highlights. In the first quarter of fiscal year 2025, Alphabet reported revenue $90.23 billion, a 12% increase year-over-year. Operating income $30.6 billion, up 20% from the previous year. Operating margin 33.9%, representing a 2.3 percentage point expansion. Net income $34.5 billion, a 46% increase year-over-year. Earnings per share, EPS, $2.81, up 49% from the previous year. Free cash flow, $19 billion for the quarter, with a trailing 12-month total of $74.9 billion. Capital expenditures, $17.2 billion, part of a $75 billion annual investment plan in generative AI. The Motley Fool +7 iEdge.io +7 Investopedia +7 Finviz +8 Toll Digital Solutions +8 Financial Times +8 Finviz +4 Rev +4 Earnings Call AI +4 Rev +2 Earnings Call AI +2 Alphabet Investor Relations +2 WSJ +1 Financial Times +1 These results underscore Alphabet's strong financial health and operational efficiency. Financial Times +2 The Guardian +2 WSJ +2 Strategic initiatives, capitalizing on AI and cloud growth. AI integration across services. Alphabet's focus on artificial intelligence has been a key driver of its recent success. The company's Gemini 2.5 AI model now powers AI snapshots in search results, engaging approximately 1.5 billion users monthly. This integration enhances user experience and reinforces Alphabet's leadership in AI-driven services. iEdge.io cloud business expansion. Google Cloud continues to be a significant growth driver for Alphabet. In Q1 2025, Google Cloud revenue increased by 28% year-over-year to $12.3 billion. The segment achieved an operating income of $2.18 billion, with an operating margin of 17.8%, up from 9.4% in the previous year. The Guardian +4 Toll Digital Solutions +4 Investopedia +4 Toll Digital Solutions +2 The Motley Fool +2 Rev +2 Shareholder returns and capital allocation. Alphabet remains committed to returning capital to shareholders. The company increased its quarterly dividend by 5% to 21 cents per share and authorized an additional $70 billion in stock buybacks. Nasdaq WSJ +4 Investopedia +4 Toll Digital Solutions +4 Competitive landscape, navigating industry challenges. Despite facing challenges such as global economic turbulence and rising tariffs, Alphabet has demonstrated resilience. The company's digital content model allows it to avoid cost hikes from tariffs, unlike competitors reliant on physical goods. Analysts maintain a positive outlook on Alphabet, citing its strong content library, expanding advertising business, and strategic investments in AI and cloud services. Wall Street Journal Future Outlook, Growth Catalysts and Risks. Growth catalysts. AI integration. Continued advancements in AI technology are expected to enhance user experience and drive engagement across Alphabet services. Cloud expansion. Ongoing growth in Google Cloud services, particularly in AI and enterprise solutions, is anticipated to contribute significantly to revenue. Global reach. Alphabet's diverse product offerings and global presence position it well to capitalize on emerging markets and technological advancements. Risk factors. Regulatory scrutiny. Alphabet faces ongoing regulatory challenges, including antitrust lawsuits in the US and scrutiny from international regulators. Economic uncertainty. Global economic conditions, including trade tensions and potential recessions, could impact advertising budgets and consumer spending. Competitive pressures. Intense competition from other tech giants in AI, cloud services, and digital advertising may affect market share and profitability. The Guardian conclusion. Alphabet Incorporated has demonstrated strong financial performance and strategic initiatives that position it well in the competitive tech industry. The company's focus on AI integration, cloud business expansion, and shareholder returns provides a solid foundation for sustained growth. However, investors should remain mindful of potential risks, including regulatory challenges and economic uncertainties. Earnings call AI +3 Nasdaq +3 Rev +3 Note. This article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions. Tesla Incorporated, TSLA, Stock Analysis, a critical look at innovation, execution, and market positioning. Disclaimer: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a licensed financial advisor before making investment decisions. Introduction. Tesla Incorporated, Nasdaq, TSLA, has long been recognized as a pioneer in the electric vehicle, EV, sector, synonymous with innovation, bold strategy, and disruptive technology. However, as of mid-2025, Tesla finds itself in a more complicated phase of its evolution. While it remains a major player in clean energy and automotive innovation, a range of challenges, from intensifying competition to execution risks, have led investors and analysts to reassess the company's valuation and growth prospects. As of May 17, 2025, Tesla stock is trading at $349.98. This price reflects a mix of confidence in Tesla's long-term vision and concerns over its short-term execution and market dynamics. Financial performance, signs of slowing momentum. Q1 2025 earnings snapshot. Tesla's Q1 2025 earnings revealed a deceleration in growth. Revenue, $24.5 billion, down 5% year-over-year. Net income, $934 million, compared to $1.2 billion in Q1 2024. Operating margin, 12.5%, down from 15% the previous year. Free cash flow declined due to increased capital expenditure and lower margins. Deliveries, 386,810 vehicles, below expectations. These numbers point to pressures on Tesla's automotive segment. Unit sales are softening in key markets like North America and Europe, and price cuts aimed at maintaining volume have compressed margins. Strategic initiatives, bold moves with mixed results. Robotaxi pilot launch. Tesla is planning a pilot program for its long-awaited robotaxi service in Austin, Texas. The initial fleet will consist of 10 to 20 autonomous vehicles, with heavy dependence on teleoperations to handle edge cases. While this marks a significant milestone for the company's full self-driving (FSD) vision, critics have raised concerns about safety, latency in teleoperations, and regulatory approval. Whether this pilot transitions into a scalable and safe commercial product remains uncertain. Dojo supercomputer. Tesla's Dojo supercomputer represents a critical part of its AI ambitions. Designed to process massive video datasets from Tesla's vehicle fleet, Dojo is intended to accelerate the training of neural networks underpinning the FSD system. Tesla has committed billions to the development of Dojo, viewing it as a strategic asset not only for autonomous driving but potentially for broader AI and robotics applications. The company believes Dojo could one day rival third-party cloud providers like AWS and Google Cloud in machine learning capabilities. Competitive landscape. The EV field is getting crowded. Tesla's first-mover advantage in the EV industry is narrowing. Head-to-head with BYD. Chinese automaker BYD has overtaken Tesla in several key metrics. EV sales, Q1 2025, BYD sold over 1 million EVs, including 416,388 BEVs, compared to Tesla's 386,810. Revenue growth. BYD's revenue grew by 36% year-over-year, while Tesla's declined. Net income, BYD posted $1.26 billion, exceeding Tesla's $934 million. BYD's success, particularly in Asia and Europe, underscores Tesla's vulnerability to localized players with better cost structures and deeper government support. U.S. market pressure in California, Tesla's original stronghold, Q1 2025 EV registrations fell by 21%. In contrast, other EV brands saw a 14% rise collectively. Tesla's market share dropped below 40%, down from nearly 50% a year earlier. Demand for the Cybertruck and refreshed Model Y has underwhelmed, pointing to potential issues with product market fit and innovation pacing. Growth drivers, where Tesla still holds an edge despite the headwinds. Tesla is not without strengths and forward momentum. Software and autonomy. Tesla continues to lead the industry in over-the-air updates, driver assistance features, and real-world data collection for autonomy training. If its FSD suite can reach regulatory and safety milestones, Tesla could redefine not just personal transportation but also commercial mobility services. Energy division. Tesla's energy generation and storage business, including solar roofs and the Powerwall and Megapack battery systems, posted strong double-digit growth. Though still a smaller part of the overall business, this segment diversifies revenue and aligns with the global push for decarbonization. AI and in-house chip development. In addition to Dojo, Tesla is investing heavily in its own silicon for AI workloads. This vertical integration could give Tesla greater control over product design and optimization, key for edge computing in vehicles and autonomy. Risks, headwinds that could stall progress. Operational and execution risks. Delays in launching new models, particularly the next-gen $25,000 EV, and scalability issues at new factories, such as in Mexico and India, could weigh on Tesla's growth targets. Regulatory and legal pressures. Tesla is under scrutiny globally for its claims about full self-driving capabilities. Litigation and regulatory restrictions may impact rollout timelines and consumer trust. Macroeconomic and trade risks. Tariffs, especially between the US and China, threaten to raise costs. Fluctuating lithium and battery input prices could also affect margin stability. Brand and market positioning. Tesla's brand perception in key Western markets has taken a hit. Political associations, product recalls, and inconsistent communication have led to erosion in consumer loyalty and mainstream appeal. Outlook and valuation, repricing growth. Tesla's stock, trading at a forward PE of around 52 as of May 2025, remains priced for growth. However, with revenue growth slowing and margin compression becoming a pattern, investors are beginning to demand more execution and less narrative. Analyst consensus. Analyst opinion remains divided. Bulls believe Tesla's vertical integration, software moat, and autonomy breakthroughs will eventually pay off. Bears cite declining market share, fierce competition, and lackluster near-term innovation as red flags. The next few quarters, particularly progress with the robotaxi program and scaling of the next-generation vehicle platform, will be crucial in determining whether Tesla can justify its current valuation. Conclusion. Tesla remains one of the most polarizing and closely watched companies in the world. In 2025, it faces a complex reality, immense potential tempered by real-world constraints. The coming months will test the company's ability to convert its vision into scalable, profitable execution. For long-term investors, the Tesla thesis now rests not just on belief in Elon Musk's vision, but on data, delivery, and adaptability in a changing competitive landscape. Note: this article is for informational purposes only and does not constitute financial advice. Always perform your own due diligence or consult with a financial advisor before making investment decisions. Intuitive Surgical Incorporated, ISRG, Stock Analysis, Navigating Growth and Leadership Transition. Current stock price, $563.60, as of May 17, 2025. Market Watch +1 Guru Focus +1 Market Cap, approximately $65 billion. Investors Business Daily +1 Investors Business Daily +1 PE ratio, approximately 45. Investors Business Daily Dividend Yield, NA. Financial performance, robust growth in Q1 2025. Intuitive Surgical reported strong financial results for the first quarter of 2025, driven by increased demand for its Da Vinci surgical systems and related procedures. Investor.intuitivesurgical.com +6 Market Chameleon.com +6 Intuitive ISRG +6 Revenue, $2.25 billion, a 19% increase year-over-year. GAAP net income, $698 million, or $1.92 per diluted share, up from $545 million, or $1.51 per diluted share, in Q1 2024. Non-GAAP net income, $662 million, or $1.81 per diluted share. Gross margin, 66.4%, slightly down from 67.6% in the previous year, due to higher facilities costs and a mix of newer lower-margin products. Operating expenses increased by 12% due to higher headcount and facilities-related costs. Cash position, ended the quarter with $9.10 billion in cash equivalents, and investments. Forbes +4 Guru Focus +4 Mumu +4 Mumu +6 Guru Focus +6 Market Chameleon.com +6 Guru Focus +3 Market Chameleon.com +3 Guru Focus +3 Mumu +1 Guru Focus +1. The growth was primarily driven by a 17% increase in worldwide Da Vinci procedures and a 15% increase in the installed base of Da Vinci surgical systems. Notably, 147 of the 367 systems placed during the quarter were the newly launched Da Vinci 5 systems, indicating strong market acceptance. Nasdaq +8 Guru Focus +8 Investor. Intuitivesurgical.com +8 Investors Business Daily +11 Guru Focus +11 Guru Focus +11 Strategic initiatives, expanding product portfolio and global reach. Intuitive Surgical continues to innovate and expand its product offerings to maintain its leadership in the robotic-assisted surgery market. Guru Focus Da Vinci 5 System. The launch of the Da Vinci 5 system has been well received, with 147 units placed in Q1 2025. The company anticipates further adoption as international regulatory approvals are expected by the end of 2025. Mumu Ion Platform. The Ion robotic-assisted bronchoscopy platform saw a 58% increase in procedures year-over-year. The platform has received regulatory clearance in Australia, and pending acceptance in other international markets represents a significant growth opportunity. Guru Focus Mumu SB Platform. The SB single-port robotic system experienced a 94% increase in procedures year-over-year, highlighting its growing adoption in thoracic and colorectal surgeries. These initiatives are part of Intuitive Surgical's strategy to diversify its product portfolio and expand its presence in international markets. Guru Focus Leadership Transition. CEO Gary Guthart steps down in a significant development. CEO Gary Guthart announced his decision to step down effective July 1, 2025, transitioning to the role of Executive Chairman. Dave Rosa, the company's current president and a 29-year veteran, will take over as CEO. Rosa has played key roles in developing the Da Vinci SB and Ion robotic surgery systems and has held leadership positions in engineering, product development, and marketing. Analysts remain optimistic about the company's prospects, with 20 out of 35 offering by equivalent ratings. Investors Business Daily +1 Mumu +1 Competitive landscape. Facing increased competition while Intuitive Surgical maintains a dominant position in the robotic surgery market, it faces increasing competition from companies like Medtronic and Johnson & Johnson. These competitors are developing their own robotic-assisted surgery systems, which could impact Intuitive Surgical's market share. However, the market remains underpenetrated, with room for multiple players, and Intuitive Surgical's continued innovation and strong performance position it as a leading force in the industry. Investors Business Daily Future Outlook, Growth Projections and Market Trends. Intuitive Surgical projects global Da Vinci procedure volume growth between 15% and 17% for the full year 2025. Company also expects gross margin to decline to 65%-66.5%, down from 69.1% in 2024, due to higher operating expenses and a mix of newer lower margin products. Despite these challenges, the company's strong product portfolio and expanding international presence position it well for continued growth. Market Chameleon.com +7 Forbes +7 Nasdaq +7 Conclusion. Intuitive Surgical's strong financial performance in Q1 2025, coupled with its innovative product offerings and strategic initiatives, underscores its leadership in the robotic-assisted surgery market. While the company faces increased competition and potential challenges related to its leadership transition, its robust pipeline and market position suggest a positive outlook for the future. Note: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions. Uber Technologies Incorporated, UBER, Stock Analysis, Strong Financials and Strategic Growth. Current stock price, $91.79, as of May 17, 2025. Market cap, approximately $91 billion. PE ratio, approximately 108 seconds. Boardroomalpha.com. Dividend yield, NA. Financial performance, robust growth and profitability. Uber Technologies reported strong financial results for the first quarter of 2025, demonstrating robust growth across its core segments. Revenue, $11.5 billion, a 14% increase year over year, slightly missing the estimated $11.615 billion. Guru Focus earnings per share, EPS, 85 cents, surpassing the estimated 50 cents, indicating strong profitability. Guru Focus net income, $1.8 billion, a significant turnaround from a net loss of $654 million in the same quarter last year. Guru Focus adjusted EBITDA, $1.9 billion, up 35% year over year, with a margin of 4.4% of gross bookings. Uber Investor Relations +3 Guru Focus +3 Guru Focus +3 free cash flow, $2.3 billion, reflecting a robust 66% increase from the previous year. Guru Focus. These results underscore Uber's operational efficiency and its ability to generate strong cash flows, positioning the company for sustained growth. Strategic initiatives, expanding offerings and enhancing user experience. Uber continues to innovate and expand its service offerings to enhance user experience and drive growth. New product launches. At its annual GoGet conference, Uber introduced several new features, including a price lock pass that allows riders to avoid surge pricing by locking in fares on specific routes for $2.99 per month. Investors Business Daily +1 Baron_S+1 partnerships. Uber announced a partnership with Waymo in Austin, showing high utilization of autonomous vehicles. Guru Focus. These initiatives aim to enhance customer satisfaction and expand Uber's market presence. Market outlook, analyst perspectives and growth projections. Analysts maintain a positive outlook on Uber's stock, citing strong fundamentals and growth potential. Barron's price targets. Wells Fargo raised its price target to $100, citing strong trends in Uber's mobility and delivery segments and the likelihood of upward estimate revisions. Baron_S+4 Baron_S+4 Nasdaq +4 growth projections. For Q2 2025, Uber anticipates gross bookings of $45.75 billion to $47.25 billion, representing growth of 16% to 20% year over year on a constant currency basis. Uber Investor Relations +1 second.boardroomalpha.com +1 These projections reflect confidence in Uber's ability to sustain growth and profitability. Conclusion. Uber Technologies Incorporated has demonstrated strong financial performance and strategic growth initiatives in 2025. With robust earnings, expanding service offerings, and positive analyst outlooks, Uber is well positioned for continued success in the evolving transportation and logistics sectors. Guru Focus +1 Guru Focus +1 Note: this article is for informational purposes only and does not constitute financial advice. Always conduct your own research or consult with a financial advisor before making investment decisions.